All right, so today we're diving into investing wisdom, and we've got some great excerpts from Peter Lynch's One Up on Wall Street for this deep dive.
It's a classic.
Oh yeah, this one's going to be good. I have a feeling you guys are really going to enjoy this one.
You know.
Peter Lynch,
Mm-hmm.
this guy's a legend. He managed the Magellan Fund at Fidelity
Right.
and grew it
Yeah,
over 24 times its original size.
that's right. An incredible track record.
That's insane.
And
Yeah.
what's really fascinating
Yeah.
is that Lynch believes that anyone can learn to invest successfully.
Really?
He actually argues that everyday investors like you listening right now have a hidden advantage.
Okay, now I'm intrigued. What's this advantage we supposedly have?
Well, think about it.
Okay.
We're out in the world experiencing things firsthand. We see trends emerging in our neighborhoods, at our jobs, even at the grocery store, long before they show up in some analyst's report.
So we're like walking, talking market research machines.
Exactly. Lynch calls it being closer to the action. Yeah, he has this great story about how his wife Carolyn noticed how popular leg stockings were at the grocery store.
Oh, yeah.
That simple observation led them to invest in Hanes, and it turned into a six-bagger for them.
A six-bagger.
Yeah,
So their initial investment grew 6 times over.
that's right.
That's wild.
Yeah,
It really shows that sometimes the best investment ideas are right in front of us.
absolutely. And while we're out there living our lives and spotting these trends,
Yeah.
professional investors are often stuck behind their desks,
Right.
poring over spreadsheets and listening to what everyone else is saying.
It's like they're trapped in an echo chamber, missing out on what's actually happening in the real world.
Exactly. Lynch argues that professional investors can be slow to react to promising opportunities because they're so focused on what everyone else is doing.
Makes sense.
Plus, they often have restrictions on what they can invest in,
Right.
which further limits their options.
So what does this mean for someone like me who's just starting out in investing?
It means you have a unique perspective that Wall Street might be missing.
Okay.
Lynch encourages people to invest in what they know.
Mm-hmm.
Think about your interests, your hobbies, your job.
Yeah.
What are the companies that stand out to you in those areas?
That's a good question. I'm a big coffee drinker,
Yeah.
and I've always been impressed with how Dunkin' has managed to expand so rapidly.
Oh, yeah.
They seem to be popping up on every corner.
They're everywhere.
They really are.
That's a great example.
Yeah.
Lynch himself invested in Dunkin' Donuts based on his personal observations.
Ollie.
He saw their potential before they became a national giant.
Wow.
He also invested in companies like Taco Bell and La Quinta Motor Inns based on his own experiences.
So he was essentially taking his everyday observations and turning them into investment opportunities.
Yeah.
That's pretty cool.
It is, but before you go running out to buy stock in every company you like,
Right.
there's a crucial piece of the puzzle we need to talk about: research.
Okay.
Lynch is adamant that stocks are not lottery tickets.
So it's not just about following your gut.
Right.
You need to dig deeper and actually understand the businesses you're investing in.
That's right. He doesn't want us to just blindly throw money at companies that make products we like.
Okay.
We need to understand their financials, their competitive landscape, and their overall strategy.
So where do we even begin with all that?
Right. It can feel really overwhelming when you're first starting out.
It really can.
Yeah. Lynch provides a really helpful framework for breaking things down.
Okay.
He classifies stocks into 6 categories:
Right.
slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays.
Okay, let's unpack those categories a bit. What exactly does Lynch mean by a slow grower?
So slow growers are companies that are well established and reliable, but their growth is slow and steady.
Okay.
Think of utility companies or large consumer staples companies.
Mm-hmm.
They might not be the most exciting investments,
Right.
but they tend to be less volatile and can provide a decent dividend.
That makes sense. So what about stalwarts? How do those differ from slow growers?
So stalwarts are like the bigger, more established cousins of fast growers.
Right.
They're large, well-known companies with a history of consistent earnings growth,
Hmm.
but they're not growing at breakneck speed anymore.
Gotcha.
Think of companies like Coca-Cola or Procter & Gamble.
Okay, I'm starting to see the difference. So slow growers are the slow and steady tortoises?
Right.
And stalwarts are the companies that have already won a few races,
Yeah,
but might not be sprinting anymore.
exactly.
Good analogy.
Now, fast growers are the ones that really get investors excited.
Okay.
These are the companies that are expanding rapidly, often in emerging industries.
Mhm.
They have the potential to deliver huge returns, but they can also be more volatile.
Yeah, I can see how those would be appealing, high risk, high reward.
Right.
What about the other categories? What are cyclicals?
So cyclicals are companies whose fortunes are tied to the ups and downs of the economy.
Okay.
Think of car manufacturers or airlines.
Hmm.
When the economy is booming, these companies tend to do well.
Yeah.
But when times are tough, they can struggle.
So they're a bit more unpredictable.
Definitely, investing in cyclicals requires a good understanding of economic cycles and the ability to time your entry and exit points.
That sounds a bit advanced for me right now.
Yeah.
What about turnarounds?
So turnarounds are companies that have fallen on hard times
Okay.
but are showing signs of recovery.
Mm.
These can be risky investments, but if you can identify a company that's successfully turning things around, the potential rewards can be significant.
So it's like betting on the underdog.
In a way, yes, but it requires careful analysis to determine if the company's turnaround strategy is actually working.
Makes sense. Okay, we've got one category left, asset plays. What are those all about?
Asset plays are companies that have valuable assets that are not fully reflected in their stock price.
Okay.
This could be anything from real estate to patents to cash on hand.
Mm-hmm.
Lynch loves finding these hidden gems because they offer the potential for a big payoff if the market eventually recognizes the true value of the assets.
So it's like finding buried treasure.
Exactly, but of course it requires a keen eye for identifying undervalued assets.
Okay, this is all starting to make sense, but knowing these categories is just the first step.
Right.
How do we actually evaluate individual companies within each category?
That's where Lynch's 2-minute drill comes in.
2-minute drill.
Yeah, it's a set of key questions he uses to quickly assess a company's fundamentals.
Okay.
He focuses on things like earnings growth, debt levels, and cash flow.
Sounds simple enough. Where do we find this information?
Most of it can be found in a company's annual report or financial statements, which are publicly available.
Okay, so I'm looking at a company's financials,
Mm-hmm.
and I see something called the PE ratio.
Okay.
What exactly is that, and why should I care about it?
So the PE ratio is a measure of how much investors are willing to pay for each dollar of a company's earnings.
Hmm.
It can be a useful tool for gauging whether a stock is overvalued or undervalued.
So a high PE ratio means investors are really optimistic about the company's future growth prospects.
Exactly, but Lynch cautions against getting too caught up in high PE ratios because sometimes the expectations are too high and the company can't deliver.
So a high PE ratio isn't always a good thing.
Not necessarily. It really depends on the company's growth rate and the overall industry dynamics.
Okay, so we've got our categories and our 2-minute drill.
Mm-hmm.
What else should we be looking for when evaluating a potential investment?
Well, Lynch has this list of 13 favorable attributes that he looks for in a company.
13.
Yeah.
Okay.
These are like little clues
Mhm.
that can point you towards a potential winner.
Ooh, 13 clues.
Yeah.
Give me one.
Okay.
What's something surprising that Lynch looks for?
He actually loves companies with boring names and industries.
Boring.
Yeah.
Doesn't sound very exciting.
I know, right?
Yeah.
But Lynch's logic is that these companies often fly under Wall Street's radar
Okay.
because they're not flashy or trendy.
Interesting.
This means they might be undervalued and offer a great opportunity for savvy investors.
So I shouldn't be afraid to dig into companies that might not be making headlines.
Exactly. In
Yeah.
fact, Lynch sees opportunity in companies that others might shy away from,
Okay.
like those with negative rumors circulating about them, companies that are spin-offs from larger corporations, and even those in industries that most people find, well, depressing.
Depressing industries. What kind of companies are we talking about here?
He specifically mentions Service Corporation International,
Okay.
the funeral home company, as an example.
Okay. That's definitely not the most glamorous industry.
All right, but it's a necessary business, and it's one that's likely to be around for a long time.
It's true.
Plus, because it's not a Wall Street darling, it might be undervalued.
So Lynch is looking for the diamonds in the rough,
Yeah.
the companies that everyone else is overlooking.
Precisely. He also loves companies that have a niche market.
Okay.
Those that are buying back their own shares, and those where company insiders are buying stock.
Mm-hmm.
These are all signs that the people who know the company best believe in its future.
It's like they're putting their money where their mouth is.
Exactly.
Yep.
And it's a good sign for potential investors.
Very good sign.
Yeah.
This is fascinating stuff. I'm starting to see how investing can be like detective work,
Yeah.
looking for clues and piecing together a story. It's not just about numbers on a spreadsheet. It's about understanding the underlying business and its potential.
That's exactly the mindset Lynch wants us to have. He's not looking for quick flips or hot stock tips.
Right.
He wants us to find solid companies with a real competitive advantage, something that sets them apart from the crowd and gives them the potential for long-term growth.
That makes sense.
Mm.
But how do we know if a company's advantage is sustainable? Couldn't something come along and disrupt their business model?
That's a great question, and it's one that Lynch addresses head on. He warns against getting caught up in the hype surrounding hot stocks and hot industries.
Oh, yeah, we've all been tempted by those, haven't we? The companies that everyone is talking about and the stock price is soaring.
Hmm.
It's hard to resist the allure of those quick gains.
I know what you mean, but Lynch reminds us that often those high-flying companies are built on hype and unsustainable growth. Remember the dot-com bubble?
Oh, yeah,
So many companies were shooting for the moon,
I do.
but when the bubble burst, a lot of them came crashing back down to earth.
Ouch. Yeah. I remember hearing stories about people losing a lot of money during that time. It's a good reminder that what goes up can also come down.
Exactly. Lynch uses the example of Xerox. Back in the day, it was the company to own. Everyone wanted a piece of Xerox.
Yeah.
But when competition heated up and their growth slowed, the stock took a major hit.
So even a seemingly invincible company can lose its edge.
Absolutely. That's why Lynch stresses the importance of looking beyond the hype and really understanding the underlying business. He wants us to ask ourselves, does this company have a durable competitive advantage? Can they defend their market share against rivals? Are their profits growing sustainably?
So we need to be critical thinkers, not just cheerleaders, for the companies we like.
Precisely. And speaking of things to be wary of, Lynch also cautions against what he calls diversification.
Diversification.
Yeah, it's his clever term for poorly planned acquisitions. Companies often try to grow by buying up other businesses, but if those acquisitions aren't a good strategic fit, it can lead to a real mess.
So it's not always bigger is better.
Yeah.
Sometimes it's better to focus on what you do well and not try to be everything to everyone.
That's often the case. Lynch contrasts the stories of two shoe companies, Melville and Genesco.
Okay.
Melville successfully diversified by expanding into retail, but Genesco went on a reckless acquisition spree and ended up in a terrible financial position.
So Melville was like a careful chess player,
Yeah.
strategically making moves while Genesco was playing checkers, just jumping all over the board.
That's a great analogy. Melville was thoughtful and strategic, while Genesco was just chasing after shiny objects.
It's a good reminder that not all growth is created equal. We need to look at how companies are growing and whether those growth strategies are sustainable.
Right, and while we're on the topic of things to avoid, Lynch has no patience for those tempting whisper stocks.
For stocks?
Have you ever heard of those?
Whisper stocks. Is that like those stocks that people are secretly whispering about in the back alleys of Wall Street?
Well, not quite. Whisper stocks are those companies that have amazing stories. They're always on the verge of some groundbreaking discovery or revolutionary product.
Uh-huh.
But the problem is they rarely deliver on those promises.
Oh, I see. It's all hype and no substance.
Exactly. They're long shots. And Lynch has lost money on every whisper stock he's ever bought.
Oh, wow.
He says they're more like lottery tickets than sound investments.
So we need to be wary of those companies that sound too good to be true.
Absolutely. Remember, investing is not about gambling or chasing after the next big thing. It's about finding companies with solid fundamentals, those that are quietly building value over time.
That brings us back to Lynch's emphasis on the long-term view, doesn't it? He's not about trying to time the market or make a quick buck. He wants us to find great companies and hold on to them for the long haul.
Exactly. He believes in building a portfolio that aligns with your personal risk tolerance and investing goals. And then holding those stocks patiently, letting the power of compounding work its magic.
But the stock market can be so volatile. It's tempting to try to jump in and out, buying when prices are low and selling when they're high.
I know it's tempting, but Lynch cautions against trying to time the market. He reminds us that the stock market is like a roller coaster. There will be ups and downs, but over time, the companies with strong fundamentals will prevail.
So we need to ride out the bumps and focus on the long-term destination.
That's the idea. Don't get spooked by short-term market fluctuations. Instead, focus on the underlying businesses and whether their long-term prospects are still intact.
This all sounds very zen. It's about being patient and disciplined, not letting our emotions get the best of us.
Exactly. And speaking of emotions, Lynch is a master at debunking common investing myths, those irrational beliefs that can lead us astray.
Oh, I'm sure we've all fallen prey to some of those. What are some of the myths that Lynch tackles?
Well, one of the most dangerous things people say is if it's gone down this much already, it can't go much lower.
Oh,
We've all been tempted to think that way, right?
oh, absolutely.
Yeah.
I've definitely been there. It seems like a bargain when a stock has already taken a big hit.
But as Lynch points out, there's no rule that says how low a stock can go.
Right.
It can keep falling until the company goes bankrupt or turns things around. So just because a stock has dropped a lot doesn't mean it's a good buy. You need to understand why it's fallen and whether there's a good reason to believe it will recover.
That's a sobering thought. It's easy to get caught up in the idea of a bargain and forget to do your due diligence.
Another myth Lynch debunks is the idea that you can always tell when a stock has hit bottom. He calls this bottom fishing and warns that it's a dangerous game.
So trying to catch a falling knife, that doesn't sound like a good strategy.
It's incredibly difficult to time the market perfectly and catch a falling stock at its lowest point. It's much safer to wait for signs of a turnaround before jumping in.
So look for evidence that the company is addressing its problems and making positive changes.
Exactly. And here's one I bet you've heard before. It's gone this high already. How can it possibly go higher?
Oh yeah, I've definitely thought that one myself. It can feel like a stock has already run its course, like the best is behind it.
But Lynch reminds us that there's no arbitrary limit on how high a stock can go if the story stays good, if the company keeps executing well and earnings keep growing, the stock price can continue to climb. He uses the example of Philip Morris, which went on an incredible multi-decade run, defying all those who thought it had peaked.
So we need to be careful not to limit our thinking. If a company has a long runway for growth, it's possible for it to keep exceeding expectations.
That's a great takeaway. Don't underestimate the power of a well-managed company operating in a growing market. But that's not to say we should just blindly hold on to stocks forever. Lynch emphasizes the importance of staying vigilant and rechecking the company's story periodically.
So we need to keep an eye on our holdings and make sure they're still living up to our expectations.
Exactly. He's always asking, has anything changed? Has the competitive landscape shifted? Has the company made a misstep? Has the original investment thesis been invalidated? If the answer to any of these questions is yes, it might be time to reconsider your investment.
So we need to be active investors, not passive bystanders. We need to monitor our holdings and be prepared to sell if the fundamentals deteriorate or the story no longer makes sense.
That's right. And sometimes that means making tough decisions. Lynch warns against getting too attached to our stocks. We can't let our emotions cloud our judgment if a company is no longer meeting our expectations. It's time to move on no matter how much we might like the product or the management team.
So it's like pruning a garden. Sometimes you need to cut back the dead branches to allow the healthy ones to flourish.
That's a great way to think about it.
Yeah, it really does sound like, he really wants us to be engaged investors, informed investors,
Yeah.
making smart decisions based on our research, our analysis, and not just emotions or speculation.
Right, he even cautions against getting involved in speculative investments like options, futures, and short selling.
Yeah.
He points out that these are often zero-sum games where you're betting against sophisticated professionals
Right.
who have more information and resources than you do.
So it's like playing poker with the sharks. You're probably going to lose your shirt.
It's definitely a high-risk game.
Yeah.
He compares these activities to gambling and says they're not a good way to build long-term wealth.
And short selling especially sounds super risky because there's technically no limit to how much you can lose.
Right. You got it with short selling. You're essentially betting that a stock will go down.
Right.
But if you're wrong and the stock goes up instead, your losses can be unlimited.
That's a scary thought.
Yeah.
Yeah, it seems like sticking with long-term investing in solid companies is a much safer bet.
Lynch would definitely agree with you there. His message is clear. If you want to build wealth in the stock market, focus on finding great companies and investing in them for the long term.
Hmm.
Don't get distracted by speculative investments that can quickly wipe out your savings. Stick with the fundamentals.
It's refreshing to hear that he believes in the power of individual investors. He doesn't think the stock market is rigged against us.
Yeah.
He really believes anyone can learn to pick winning stocks with the right approach.
Right.
It's inspiring.
Yeah. He's definitely a champion for the little guy.
Yeah.
He shows us that we don't need to hand over our money to Wall Street professionals
Right.
and hope for the best. We can take control of our own financial futures by learning to invest intelligently.
And he makes it clear that the stock market isn't some mystical casino where luck is the only factor.
Right.
It's a place where we can become part owners of great businesses and share in their success.
Exactly. He gives us the tools and the encouragement to succeed as investors.
So to recap, we've learned that investing is not about gambling or trying to outsmart Wall Street.
Right.
It's about understanding businesses, doing our research, and finding those companies with a sustainable competitive advantage that can deliver strong earnings growth over time.
It's about being patient disciplined and focusing on the long term, not getting swayed by short-term market noise
Right.
or emotional
And
reactions.
most importantly, Lynch reminds us that anyone can learn to invest successfully.
Yeah,
We don't need a fancy degree or a high-powered job on Wall Street.
that's right.
We just need to be curious, observant,
Hmm.
and willing to put in the time and effort to learn.
And we need to remember that we as everyday investors actually have a unique edge.
That's right.
We're out in the world experiencing things firsthand, observing trends as they emerge.
Yeah.
We might be seeing investment opportunities that Wall Street hasn't even noticed yet.
Thinking back to Lynch's example of Dunkin' Donuts,
Uh-huh.
have you ever considered the reasons behind their success? What did Lynch see in that company that others might have missed? You mentioned you were a coffee drinker,
Yeah,
so maybe this is one you've thought about before.
it's a great question to consider. What about you?
Yeah.
What trends are you seeing in your own life, your own community, your own workplace?
Are there any emerging companies or products that are starting to gain traction?
Yeah.
Any industries that are being disrupted or transformed by new technologies? Those are the kinds of things that Peter Lynch would be paying attention to.
Mm-hmm.
And as we've learned from his book, it's a powerful approach to investing.
He wouldn't be glued to a computer screen obsessing over stock charts
Right.
or listening to what these so-called experts are saying. He'd be out there in the real world looking for the next big thing
Right.
before it becomes obvious to everyone else.
So now it's our turn to put on our detective hats and start exploring. Keep your eyes open. Stay curious.
And who knows, maybe you'll be the one to discover the next 10-bagger.